And now to the bond market, where high yield or junk bonds are headed for their first annual loss since the credit crisis. And that may be flashing a warning sign for stocks and the economy. Mike Santoli explains.
As 2015 winds down, junk or high yield bonds have become a leading worry for investors. Credit conditions have historically led equity markets, especially around economic turning points. So with the junk bond market conspicuously weak in recent weeks, stock investors are wondering if a significant economic slowdown is imminent. Take a look at the interest rate spread over treasuries. It's near its high for the year and not far from its post-financial crisis high. There are three main takeaways here. First, there's significant risk aversion by credit investors as they demand higher yields to compensate for the hazard of holding them. Second, the default rate on these riskier bonds has been climbing, with the number of distressed bonds now at a 6-year high. And third, the likelihood of a Fed rate hike next week seems to have scared some money out of junk bond funds. That's because no one is quite sure how this sensitive sector of the bond market might respond to a slight change in short-term rates. As you can see, the S&P 500 has managed to climb back toward its highs of the year despite the continued pressure on high-yield bonds. So what has bond investors so anxious? Much of the pain is centered in energy bonds, now under stress due to the low oil and gas prices, though the weakness has begun to extend outside the commodity-related sectors just a bit. Looking past December, investors worry about the maturity cliff of bonds set to come due beginning in 2017, and the market is starting to sort out just how much of that debt won't be paid back. Distressed issuers have about $145 billion in bonds scheduled to mature between 2017 and 2021. Plenty of issuers have bonds already trading at levels that imply high risk of default. In addition to petroleum and coal producers such as Chesapeake Energy, Arch Coal, and Peabody, some struggling consumer and industrial companies like Avon and Titan International have bonds priced at distressed levels as well. Note that some market handicappers think the junk market is overstating the threats to the stock market. Goldman Sachs last week said high yield was sending, quote, a false recession signal. And the stock market might not be as oblivious as it seems when it comes to heeding the message of the bond market. Energy and industrial stocks, after all, have lagged badly, and the small number of stocks leading the S&P higher have been fast-growing tech and consumer stocks that aren't reliant on easy credit. For Nightly Business Report, I'm Mike Santoli.